Hey guys, Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today's another episode of the Mortgage Guy Podcast, and today we're going to touch on a few things. I wanted to give you a quick real estate tip on what's going on out there with listings, as well as some costs going on. Well, it's kind of impacting everybody, specifically the credit reporting bills, and what Pulte had to say about that at Fannie Freddie, and as well as the proposed $200 billion in mortgage-backed securities that Trump's going to be kind of sopping up out of the market. So kind of want to touch on that. But first things first, let's hit the online research that was done by Zillow, actually, our favorite search engine that's taking everybody's money and giving less and less leads every week. Anyways, what they found, and I found it very odd, actually, is because when you think listing a house or buying a house and you think real estate agent, I feel like everybody I know, everybody I've ever talked to, kind of just knows an agent, right? I feel like you can throw a stone, you hit an agent. So I always felt that everybody either used a past agent if they didn't know one, or a family member had the agent, or just a couple of family friends or family members. And come to find out, based off this research, the word of mouth situation is starting to tighten up a little bit. So back in 2018, the report showed that 15% of home sellers actually found their agent online through online research, which 15%, that's pretty low. So a lot of people aren't putting as much time and effort maybe in online advertising or, social media ads or, whatever it might be. And since then, 7 years, it's more than doubled, which was surprising to me. Again, like I said, I felt like everybody has an agent or knows an agent or has a family member or a friend that refers them. But 36% of sellers today have found their agents through online sources. That's crazy to me. It really is. What this is an indication of is doing a broader shift to more digital engagement, right? Social media advertising, any kind of ads you can put your hands on. It can be, you see people on the restaurant things. I am, on the tables and things like that. Focusing in on getting reviews done by your past clientele and sharing that out there. Google reviews is a big one. Not having a Google presence as an agent could have a pretty big impact on you. I know when you just kind of Google a realtor, a lot of just generic data usually comes up, and it's just usually the brokerage website that pulls you to them. Very few people have just their own presence when you Google them. So very odd. But just a quick tip for any of you agents out there that are watching this, 36% of today's home sellers about to list their property have found their agent online, not through word of mouth or prior relationships. So moving on from that real fast, closing costs are constantly moving and changing on us. And one of the biggest reasons isn't this thought of lenders are being greedy. The closing cost expense, they don't even scratch the surface on the actual cost to close a mortgage. It's just a way for lenders to recoup some actual hard expenses per deal, right? And one of those costs is the credit reporting bill. It is crazy. It is out of hand, but it's been reported, and I mentioned this, that there's like a 40 to 50% increase in the new pricing for 2026 year. And what happens there is it just gets passed on to the consumer. And then you have FHFA Director Bill Pulte of the Federal Housing Finance Agency. He had a lot to say about it. We've talked about him before and his feelings on it, but he stated he was confused by the credit bureau's pricing strategy, stating, "I do not understand what the credit bureaus are doing with their pricing. They're inviting a lot of scrutiny, and that is only intensifying by the day." He added that he has communicated with credit bureau CEOs, and the issue that he had brought to them has been falling on deaf ears. So costs are increasing. And one thing that people tend to forget about is the cost on the credit report isn't impacting just the buyer, right? You have to understand the impact it actually has on the operating ability of the lender, right? So if I do 100 credit pulls in a month, that bill is probably going to be like 10 grand, okay? And I'm not going to do 100 closings in a month for myself, right? I might do 20. So I want you to think about a lender's ability to actually recoup that cost. There's been a lot of discussion about people doing application fees to help offset some of these expenses that lenders are incurring. But if you think about that cost of doing business, that is pretty significant. So something to think about, and why we as a lender are pushing back as well. And the industry as a whole, the Mortgage Bankers Association, the Ohio Mortgage Bankers Association, we're all pushing back on this. There's only so much we can do. It's just a big fight with the credit bureaus. Their stocks have been tumbling a little bit over the last couple of weeks due to the news of the new pricing increases. So they're getting a lot of scrutiny. But that's why, it might not seem like a big deal if it's a little bit of an increase to a consumer, but to a lender, the expense of operating is massive when you consider how many credit pulls happen to get that one buyer. So last thing, guys, I wanted to talk briefly. This was announced just the other night. Trump was talking about buying $200 billion of mortgage-backed securities or mortgage bond buying plan. That's great news, really. During the pandemic, ever since the government kind of took over Fannie Freddie and went into conservatorship, they kind of dipped into the market and were buying up mortgage-backed securities. And that's what helped with the yield spread to help lenders stay healthy in regards to what they can make when they deliver these loans to the secondary. And it also kept rates down a little bit because it kept capital free, right? Kept capital flowing. The ability to purchase, the credit qualifying pieces loosened up a little bit because that capital was so much readily available. It wasn't tight. And so it kind of slowed down into 2022 as inflation started hitting and rates started slowly increasing. The government just started to turn off the faucet, and they just stopped buying mortgage-backed securities to a point where it just stopped altogether. And that kind of accelerated the issue with the rising rate environment. Like we've talked about before, there was a 5-point increase over 12 months, which is absolutely unheard of. And that kind of put gasoline on the fire where the government was not giving a backstop. They were not picking up MBS, and it was impacting those yield spreads, which is why you saw the rates go so fast. This administration announced that Fannie and Freddie is so healthy right now that they're going to be diving in and picking up $200 billion. Now, a single one-time $200 billion, not going to happen most likely, okay? This is going to be a purchase plan over a period of time. Just the announcement of them jumping back in, even though it might be less than typical, is going to be a massive impact on the rates, in my opinion. The market's already reacting to it. I anticipated about a 1/4 point swing in rates immediately just from the announcement taking place, and we're seeing something close to that. But with some of the projections, originally we're thinking by the end of the year being at around a 5.25 par rate between Fannie and Freddie. That's the projection. Some of the new projections are now calling it 5 with a $200 billion mortgage-backed security buying plan. So that's all good news in that front, minus the expense front on the credit reports. But hopefully we can offset some of that with some better rates here in the very near future. So hope that information was helpful, guys. A lot of information in a very, very short period of time. Remember, subscribe on YouTube. Check us out on Apple Podcasts and Spotify. Catch you all next week.